Okay, let's look at number 4 in the homework. One of the things that'll happen when you look at a problem like this is it looks like it's just asking for an enormous quantity of information. And then you click here and it shows you an enormous quantity of information. And then you might also likewise be intimidated by the fact that there's 10 parts remaining to this monster. When you encounter a problem like this, it's really important you kind of decompose it and just go piece by piece. You don't have to answer everything all at once in one fell swoop. So just take this piece by piece. Let's start with how much cash did the issuance of common stock bring in during 2014? Well, when we look here, it offers you a pretty big clue because here we're issuing stock, right? So we're issuing stock. That means that we're going to collect money. We're going to have a debit to cash and then a credit to common stock. Common stock is always par times the number of shares. By the way, when you're looking at a problem like this is par, and this is the entry that was made. If you divide the dollars by 10, which is par, you get the number of shares that were issued. We're not being asked that here, but if you're ever asked that, this tells you, the par tells you how many shares were issued because this number is always par times the number of shares that were issued. Okay, in this case, it's 32,000 times 10 is 320,000. But I digress. Just showing you in case you ever have to use that. You issued 320,000. You have additional paid-in capital of 560. What I want to show you is what this entry looks like. One of the downsides of this type of analysis is this is a statement of stockholders' equity only, so it doesn't show the cash account. Cash account's not here because it's not a stockholder equity account. But let me show you what it looks like. Okay, what I've done is I've made the entry, so I can show it to you here in a second, of what happens during 2014 when you issued the stock. Notice the first line is kind of the balance forward amounts from 2013. So all your answers are down here in the transactions that happened after December 31st, 2013. So you issued stock. Notice here that the common stock's 320, the additional paid-in capital is 560. So I've captured that here. Here's the common stock. Here is the entry for additional paid-in capital. And now it becomes very evident. Once you can see the cash account, right? Because that's what it's asking you for. It's asking you for cash brought in by the sale of common stock. Well, once you see the entry here, you can clearly see that it's 880,000, which is the sum of common stock and additional paid-in capital. Remember, additional paid-in capital is just the difference, the plug between the cash you got and par value times the number of shares issued. So this is 880. Let's go on to the next one. The easiest way to look at this is to visualize what a regular dividend would be like. A stock dividend we're going to talk about in a second, but a regular dividend, if you were issuing a regular dividend of $48,000, it would reduce retained earnings by $48,000, and of course it would cost you cash. That's why it's called a cash dividend. Okay, a stock dividend says, hey, we're going to save cash. In other words, we're telling people we want to preserve cash, but we still would like to give you something of value. What you give them is you give them common stock, right? And of course, common stock never changes. It's always the number of shares that were given as a dividend, the quantity of stock shares that were given, and then the difference between that and retained earnings is always the additional paid-in capital. Notice that all that's happening is cash is not being consumed, but we are diluting the company. We're issuing more stock, right? So basically the stock dividend that has been declared is 48,000. Put the K for the K, 48,000. This is 48, just so we keep everybody on the same page. And what's basically happened is the dividend declaration was 48,000. The common stock, in other words, the number of shares that were issued times the par value is 42,000, and the additional paid-in capital, the plug, is 6,000. But this is the entry that's made. When you look at this entry, then you can clearly see that retained earnings goes down by $48,000. Remember, retained earnings has a natural credit balance. So when you debit it, it goes down. No different than if you paid cash. When you pay cash, you also have to take it out of retained earnings. The only difference is you don't consume cash, but you have to issue stock to cover it. And that's what they're showing here. Stock dividend, you can tell once again that 4,200 shares were issued as a stock dividend. And the reason I can tell that is the par value is 10, the dollar amount is 42,000, and this number is always par times the number of shares outstanding, the number of shares that were issued. $10 times 4,200 shares is 42,000. You have to recognize the difference between the declaration of the dividend of 48,000 and 42, and that plug goes into additional paid-in capital. All that to say that what this ended up doing was dropping retained earnings by 48,000. Notice whether you pay a dividend in cash or you issue a stock dividend, retained earnings drops by the same amount. So let's do this. Decreased 48,000. Now let's look at the next one. The next one's easy to miss if you're not reading English carefully. Notice it says the stock dividend increase, decrease, no effect, total paid-in capital. Notice total is not the same as additional, okay? Because the temptation here on the stock dividend is to say, oh, it's asking for additional paid-in capital, but that word is not additional. This is total, and total is additional plus the common stock. So the effect it had on total paid-in capital is the total of these two accounts, 48,000. So come over here. This is one that you miss, like I said, because you don't pay attention to total versus additional paid-in capital. Let's look at the next one. Here it's asking you what the effect of the stock dividend, notice these are all stock dividends, not cash dividends. When you issue stock because you don't have cash or you choose to keep cash and you just give more stock as a dividend, what's the effect on basically increase, decrease, total stockholders' equity? Again, please pay close attention to the word total. When you look here and you issue a stock dividend, these two increase stockholders' equity. Common stock has a normal credit balance. You're issuing common stock. You're issuing the difference between what the dividends declared were and the common stock. Common stock's always par value times the number of shares. And you have the difference in additional paid-in capital. So these two made stockholders' equity go up. You have more stockholders' equity. Now the bad news is this entry reduced stockholders' equity. So this goes down. This drops stockholders' equity by 48,000. This increases stockholders' equity by 48,000. So no effect. Let's look at the next one. In this one, it's asking what the effect is on total assets. Notice this fixation on total. Well, if we had issued a cash dividend, notice that assets would have dropped by 48,000, right? But you did not issue a cash dividend here. It's asking you about a stock dividend, not a cash dividend. So again, you slide over to the right-hand side and you ask yourself, these entries, what effect do they have on assets, right? Well, you already said you don't want to consume assets. You want to go ahead and issue stock. So here, you have no assets. There's no asset effect to a stock dividend. Let's look at the next one. Let's look at how much the treasury stock cost you to purchase. So when you focus here, purchase of treasury stock, 12,000. We're not talking about the sale or anything else. Purchase of treasury stock. Well, when you purchase treasury stock, this is the entry you make. Cash goes down by 12,000, and treasury stock, the debit, goes up by 12,000. Well, here clearly you can see how much it cost. It cost 12,000. Going back to here, if you aren't keen on looking at the accounting entry, here it clearly says purchase of treasury stock was $12,000. I just highlight this because you don't see the cash entry. When you're looking here, you can't see cash. All you see is the stockholders' equity accounts. But this is the entry. You lower cash, you debit treasury stock for $12,000, so that's your cost. Let's look at the next one. Let's look at the Quinn's cost of the treasury stock that was sold. Well, if you remember, when the treasury stock is sold, you have the following entry. Once again, when you're calculating the cost of the treasury stock, remember the cost is the number of treasury stock shares that were sold times their average cost. Here, what it basically tells you is that you bought 12,000, right? Remember, you had some coming in, so you don't know what the average cost is of this mess. But you purchased some and then you sold some. The cost of the treasury stock is always the average cost times the number of shares issued. So when you're focusing on the cost, and that's what it's asking you for here, notice it's not saying how much did you get for this. How much you got for this is clearly 7,000. You clearly got 7,000. You can highlight that here in this entry. See, you got 7,000, but it's not asking you what you got. It's asking you what was the cost basis of the shares that were sold. Well, the cost basis is the 6,000. That would be this entry here. This entry, the 6,000 is this entry right here. Okay, and then the plug goes into additional paid-in capital treasury stock. So the answer to this one, the cost basis of the treasury stock that was sold is 6,000. Let's look at the next one. The next one's pretty easy. Basically, now you are talking about how much was the treasury stock sold for. We're not talking about buying it, we're talking about selling it. Again, if you look back to your entry, make your entry, the treasury stock cost basis was 6,000. The additional paid-in capital, I'm taking that right from here. 6,000, 1,000 is the additional paid-in capital. Now, you're not costing yourself cash. What you're doing is you're buying, you bought the treasury stock and now you're selling a portion of it. What you actually got for it, the cash you got in hand, is 7,000. What makes this a little confusing is there's no cash account here, but if the additional paid-in capital was 1,000 and the treasury stock account was 6,000, you got $7,000. All right, let's look at the next one. The next one's super easy and it's given to you. Quinn's net income. Come up here, you're looking, net income. Net income was clearly 135,000. This is the retained earnings balance that we had. This is how much net income was, which increases retained earnings. Cash dividends, stock dividends, none of this has to do with the net income. This is our net income. It's basically given to you. Let's look at the next one. Now it's asking you what comprehensive income is. Well, comprehensive income is net income plus, other comprehensive. Basically, comprehensive income is a fancy way of saying all the income that there is that results from the company being in business. You will notice that it kind of tells you that they revalued available for sale investments, resulting in an unrealized gain of $6,000. You see that it doesn't break it out. It's just buried inside that $15,000 number. And then it also tells you they had a foreign subsidiary that had a currency translation gain of 9,000. So here you see the 9,000 plus the 6,000 is giving you the 15,000. Comprehensive income is all the income that's possible. Well, you have 15,000, obviously, but in addition to the 15,000, you have net income. Net income sitting over here at 135. So 135 plus 15 is 150. Comprehensive income, income that includes net income and all other goofy comprehensive income, is 150,000. Let's look at the next one. Now it's asking you how much should be added to Quinn's accumulated other comprehensive income. Well, again, once it kind of tells you, this is comprehensive other accumulated, it kind of just changed the thing. Quinn's accumulated other comprehensive income. Well, you started with 1,000, and because of these transactions that occurred here, the $6,000 for the unrealized gain and the 9,000 for the currency difference, you should add, it just tells you right here, you need to add $15,000 to this. So again, the answer is pretty much given to you as to how much needs to be added to accumulated other comprehensive income. Accumulated other comprehensive income. Just pick this $15,000 figure up. And that concludes that problem. This type of problem can give you difficulties if you look at it and are just overwhelmed by how much stuff it's asking you all at once. Slow down if you need to, make the entries, right? So for example, if you need to understand what happened when the treasury stock was purchased, when the treasury stock was rebought, if you need to understand, hey, you know, what happens to retained earnings, if you make the entry, then you can clearly see how much cash is being gotten. You can clearly see what the effect is. Try to stay away from trying to figure out this, ooh, it's a negative, ooh, it's a positive, ooh, it's a, try to stay away from that. Orient yourself towards making the entry on a piece of scratch paper, and you should do fairly well on this type of problem. I hope this was helpful.